Discuss Peter Morici, University of Maryland economist, Steve Moore, economist for FreedomWorks and all of the things good in life, co-founder of the Club for, no, not the Club for Growth. They keep putting it in there. Committee to Unleash Prosperity with the former government hack named me. All right, gentlemen, you heard my intro riff. You may or may not agree with parts of it or all of it or not at all. Which is it? Are we going to have 1970s hyperinflation with a socialist spin? Or are we going to continue on the supply side path and inflation will be temporary? Peter Morici, I cede the floor to you.
Well, I think we're in real danger here because I think the Fed is getting too much political pressure to continue to print money. We could certainly handle a little bit higher interest rates. We're well below the norm for the decade prior to COVID. And if it would pull back on its purchases of treasuries and not validate these policies, I think that would be useful, and mortgage-backed securities as well. The real danger here is not so much that they get their whole package, but the net. Do they say get $200 billion instead of $2 trillion instead of $4 trillion in new spending, but no tax increases? You know, then that's a lot of money to be printed. It's important to recognize that it's not just whether they get taxes, it's also how much more than the taxes they get do they choose to spend. And that's really, really important. And how much does Mr. Powell validate them by running the printing presses?
So, Steve Moore, where are you? Permanent inflation? We don't know yet. You've been more moderate on this, as I recall.
Yeah, I pretty much entirely agree with your analysis. I want to put a corollary on what you said. It was a great monetary lesson that you gave your viewers. And I kind of call this the Kudlow corollary, the Kudlow-Laffer corollary, which is growth is not inflationary. Right. Right, Larry?
Right.
Growth does not cause inflation. And I think a lot of the kind of Ivy League Keynesians believe that. So, you know, growth solves all sorts of problems. We had tremendous growth under Reagan. We had tremendous growth actually under Trump, and we didn't have any inflation. Under Clinton, we had strong growth and no inflation. Now, you know, what's really puzzling about this, Larry, is you look at these other indicators. I mean, look, no question, CPI numbers are very troubling, and the commodity numbers are troubling. But somebody's got to explain to me, you know, why we've seen almost no movement upward whatsoever in the 10-year Treasury bill, because that would be, you know, an indicator of future inflation. That suggests to me the markets aren't buying the story. Now, that being said, I think you've got it exactly right. If we go on this massive spending spree and have another $2 trillion spending bill, which I think would be the worst possible policy right now, that would, I think, fuel this kind of consumer inflation. And I agree with Peter that I do worry the Fed's a little bit behind the curve on this inflation problem. I wonder if you agree with me on that one, Larry.
I like what Kevin Warsh said. We had him on the show, former Fed governor. He wrote a piece in the Journal. Peter Morici, I think you referred to it. There's no reason now the Fed should be buying mortgage bonds anymore. Housing market is hot. Housing prices are high. All it's doing is adding excess money and distorting it. So the Fed could stop buying mortgage-backed bonds, couldn't they, Peter?
Oh, absolutely. Think about it. Housing prices, in the end, have to track people's incomes and ability to pay. And essentially, we're selling houses today at inflated prices, and we'll pay for this down the road with flat housing inflation, you know, when things return somewhat to normal. We could stop. That's the first move they should make, is to stop buying those mortgage-backed securities, let mortgage rates go up, and let the housing market cool down a bit. We'll still get a very rapid pace of construction because the prices will be adequate. So lumber prices come down a bit, but that doesn't mean that people won't be buying houses.
You guys, just real quick, on the way out. Steve Moore, between now and the end of the year, does inflation get higher or slower?
I think we're going to see, you know, inflation in that 4 to 5% range right now because of these Biden policies. The Biden policies, I think, are what are really contributing to this inflation. If we've reached peak Biden, this is my theory. If we reach peak Biden and Republicans are able to stop this anti-growth agenda, then I wouldn't be so worried.
Peter Morici, between now and year end, higher or slower inflation?
I think about what we have now, maybe a little bit less because this was a very bad month, but we're going to be running 4% inflation or so well into next year. My feeling is things don't cool down until the second half of next year. And as Ricky Ricardo would say, Mr. Biden's going to have some splaining to do at the midterms.
He's got to get some splaining to do. It's not really, it's sort of the 1970s with a socialist twist, but it depends on the legislation. I agree with that. Gentlemen, you're terrific. Peter Morici, thanks so much. Steve Moore, thanks so much.